Good morning, everyone. Hope you all had a great extended weekend. As you know, trading futures involves risk, not suitable for all investors. Information and presentations for educational purposes, not a trade signal service, not intended to be financial advice. Hope you were able to get some relaxation in over the 3-day weekend. And I know for me, it takes me a couple days to kind of get back in the groove after especially the Labor Day holiday. The summer tends to be a little bit more, there's still a lot of good trading, but coming out of August, things tend to be much more challenging in the month of August. So I tend to trade pretty lightly. And then so coming out of it, it's almost like starting the new year. December is pretty light, but then January things start to pick up. But I never kind of jump back in January 2nd, guns ablazing, kind of ease back into it. And so that's what I'm doing this week as well. I also took a long weekend. I was out Thursday and Friday of last week, so getting back into it Tuesday and yesterday is kind of a good way to not make any silly mistakes as you come back. The worst thing you can do is come back from a break and you feel energized and ready to go, but then you start making some silly mistakes by trading too much right away. So better to ease into it. And some tricks you can use is to start out on a sim account. You can do this even on a daily basis. If you find that you're kind of trigger happy, you get really excited right away, you can pull up your sim account pre-market and just kind of click around, make a few trades, just kind of get that trigger finger, trigger happiness out of the way, and then you can switch to your live account. And I have a trading colleague who's done that for years and finds it very helpful. And then the other thing you can do is start maybe the first week or the first couple days back with half size. If you're feeling a little bit gun shy or just want to get back into a good rhythm. So before we get into today's trading, let's kind of take a look at what's been happening here in the bigger picture. Let's start with the weekly chart in the ES. We got that break of highs, and as soon as I drew up this horizontal, what was resistance, 28.75 1/4, expecting that we'd pull back to it after we broke highs, and that's kind of what we're getting here. Weekly chart looks good, pretty strong, tight channel as we move higher. And there's a couple ways to kind of put together a target. You can kind of come down and look at a 50% retracement and say, okay, well, what 50% stopped us right about at lows? And just to kind of see, okay, these lows back here in January, if some computers out there were using some sort of drawing from these two anchor points, give or take, 20%, we're just looking to get an idea of where is 20 to 23% beyond highs. Well, that's right about 3,000 on the S&P. And you can say, well, that makes a lot of sense. It's a big round number. We've never traded there before. 29, roughly 17 is only, 80 or so points away from 3,000. So that could be one target. And then the other thing we can do to kind of get a potential target is look at the distance in this pullback. So we traded down to about a 25.30, and we were up at 2875, so we'll call it 2500 to 2900, roughly 400 points, 3 to 400 points, and that puts us at an even bigger target if we add the 400 on top of 2900. That's up in the 3,300 range. So just to kind of give us a ballpark of, if we were to trend this fall and trend through the rest of the fall, then what might our targets look like? And so that's one way that you can use the sort of existing retracements to be able to kind of get a gauge on that. So then as we come down to the daily chart, and we zoom in a little closer, we can start to see, if we were to draw a range, oops. So if we draw this upward channel, we can see that we are in the upper half. If we were to divide the channel in half, we're trading on top of the upper end. If we dissect it down the middle, we're trading on top of in the upper half of the range and trading down at what was resistance, now acting as support, 28.75. And then if we come down even further, we don't really have a 50% retracement from this last major swing low to high that's held. A lot of times these horizontal support levels, prior highs, do a pretty good job of keeping the market up. So I'm not super concerned if we don't make it down to the 2860s. But if we go down even more to the 30-minute chart, we get this nice, very clear pullback on the 30-minute chart. Bull flag, as we have this quick move up with these gaps, and then on this pullback, very clear in the 30-minute chart, and you can see this gap up and the way. So if you have the Globex, the 24 hours worth of data on your chart, you're not going to see these gaps. So it's handy to either come up here and make it a shortcut so that you can turn it on and off really quickly, or just keep your daily chart on the trading hours only time frame. But you can see this gap up here, and whenever we have gaps, it's important to note where the close was, because if we look at the last couple of days, we traded right down to and closed this gap from 2 Fridays ago. And that's where the market stopped and bounced. So whether it's a gap down or a gap up, it's important to know where those are, because they end up acting as reversal points in a lot of cases. Coming to today and looking at the 5-minute chart, we can see that we're opening very much inside the prior day. Most of the trading range took place in, say, the upper third, but yesterday we dove down, touched that gap fill from a couple weeks ago, and then rallied into the close, formed that hammer that we saw on the daily chart. A lot of times what you'll get with hammers, notice the prior day, Tuesday, was also a hammer. And then we broke down below it, formed another hammer. It doesn't mean that the bulls are losing steam necessarily. Anytime we have a bottoming tail, that's a sign that there is buying interest. And just like anytime we have a topping tail, that's a sign that there's selling interest. And more importantly, once the candle's closed, that shows that okay, into the close, in the case of a hammer, bulls were able to overtake the bears. So the finished candle is really what we're looking at. Not so concerned with the developing candle. Then as we get to the situation where, okay, now we're opening within the prior day's range, and that candle was a hammer. Well, if we come over and look at 2 days ago, the low of that tail is 85.50. So the 85.50 is just below us. That could act as some support. We've already filled the gap that you can really see clearly here. And this gap up day's low, the day after the gap up, is an 87. So that's also right where we're trading. The overnight didn't do anything super exciting, pretty much a sideways range. Traded a little lower to 82s, a little higher to 92s. So as long as we hold the low of yesterday, it wouldn't really surprise me if we stay inside today or if we don't break yesterday's high. Another way to look at it, and this can get a little bit complex because you have to kind of picture a chart forming to the right. But a lot of times you'll get a two-leg pullback. And what I mean by that is in this pullback to the downside, we had the move up, the bull flag, the pole, and then now this pullback. And we broke the high of a candle only one time. See this little guy up here? And really that, if we look at the calendar, that move up is Monday, so the market's closed. So even though the futures markets are open for a little bit, there's not a whole lot of activity happening. But we'll call that the first pullback. The first leg, if you will, of the pullback. And then now down here, the second leg of the pullback. So breaking the high of the prior candle, when that happens a second time, I would expect a lot more follow through. So we broke the high on the third. On the third, we broke the high of Friday. That was the first leg. And then the second leg would occur when we break the high of the prior day. So today, we would have to break yesterday's high. If we just trade inside today, then yesterday's high or low are still in play because we're inside. If we don't break the high or low, then it stays with the prior day's high or low if it's just an inside day today. So that's one way I kind of look at, okay, if we break out, if we start breaking the high of the low bar, are we likely to have momentum? Well, it would be the second break of the high, since we had this little break over here. And so I would like to see that follow through. And again, that can get a little bit confusing because you're kind of picturing things into the future. But if you come back to other situations, like back here, the market pulled back and then we broke the high of the prior day of this candle on the 10th. We broke that high even just by a few ticks, and then pulled back a second time. And then as we broke the high of this hammer, that's when the follow through began. You don't always get two pullbacks, but a lot of times it will be two. So today, Stan, I'm not looking at taking the first 5-minute breakout play because we're inside the prior day's range. So the 5-minute breakout is essentially looking at the very first 5-minute bar and then putting a buy stop 1 tick above highs, putting a low stop 1 tick below lows. And I like to do that when we gap, because a lot of times a gap day, we can do a couple of things. We can gap and go, meaning we gap up and continue up. We can gap and fail and close the gap. So we gap up and then we revert and move down to where we came from, to yesterday's close. And usually, if we're outside the prior day's range, that distance between where we gap to and the prior day's close is going to be fairly big. And so there's a lot more reward built into that trade when we're within the prior day's range. So here is just yesterday, and then here's where we're at today. When we open within the prior day's range, we've already filled, I'm using air quotes, filled the gap to yesterday because we were so close where we were opening, and there's really not as much reward built in for us to move strongly in one direction. It doesn't mean that we can't move in one direction, but the likelihood that we will is decreased. So I don't take the 5-minute play when we're only if we gap up or gap down outside of the prior day's range. So we could maybe have a small gap of 2 or 3 points, but if we're still within the prior day's range, then I don't like that trade. Knowing that we're in the prior day's range and kind of building some context, we can say, okay, well, we filled the gap up yesterday, the gap up from last week here. We touched this gap fill. If we were to draw from highs to lows, just to see where would the opposing short be, it's at a 28.9750. So right about 2,900, that makes a logical sense, a big round number. In terms of news today, top of the hour, factory orders. And natural gas, that's really about it. Tomorrow, employment. And that FOMC meeting that I talk about that occurs in September, it's going to be a little bit later this month. See if I can pull that up here. Typically, trading really gets going after the September FOMC meeting announcement. And that will be the last week in September instead of usually it's the second or sometimes the third. So September 26th is when that FOMC meeting announcement will occur. So that Tuesday and Wednesday, I would expect things to not be very good in terms of trading. People are kind of waiting around for the news to to occur, and then that kind of sets the tone and the pace for the fall. So if we're going to trend, it's likely going to happen with whatever trend comes out of that move. So now that we have a little bit of time under our belt here, I can see that, okay, the high 92, the low and the overnight 82. I'm going to turn off the overnight session to clean up my chart a little bit and get a reference of where we're trading in terms of yesterday afternoon. And now we can see this big V here in the ES. We can see, okay, 15 minutes of trade have occurred, and there's been some decent number of 512 candles. The more candles that you have within a time period, within say 15 minutes, the more trade activity that's occurring. It's a direct relationship, so it makes it easy to look at the chart and kind of determine the amount of volume that's happening. So we've got this V reversal now. As I just kind of start from the left of my chart, looking at, okay, how did these retracements play out first thing in the morning? If I take yesterday afternoon's low to the opening high, okay, we pulled back here. We traded higher in one move. And then the next one from the 50 to the next high had a small bounce, but then it failed. So, okay, we got one to the upside. And then we can come from the highs down to lows. Say, how did that trade? Well, we didn't quite make it to the 50, but we did trade close to its negative 23% target. And then we can say, okay, well, how many did we just trade? One, or did we trade 3-4 times in a row? Well, you can already tell we only traded once. The next short didn't really get much of a reaction, and then we traded all the way up to highs. So just in those first couple of drawings, I can get an idea, okay, are we trading in trend, or are we just sort of back and forth? Definitely back and forth so far in the first 20 minutes. We can kind of drill down here from lows, and we can say, okay, the low was at 640 my time, 642, this little double bottom. As I come over here and look at the low tick, it occurred not in line with the low of the day. And I can come to the high 48s, 34s, and the high tick doesn't quite line up with the high price of the day, so it's not likely that the high and the low that we have here is going to be the high or low of the day. We should move out of that. Little double bottom here. We can start to see on the move down, looking on the 512 tick only, lower lows, lower highs, then this little double bottom. And as I draw from low to the next high, okay, we pulled back. We traded to one tick above the 50 and then moved to the negative 23% target. Next one, traded at the 50 and moved through its negative 23% target. So now I'm saying to myself, okay, there's some a little bit of follow through happening to the upside here. We traded at highs, and then we got a little double top, felt some pressure from the bears, and we've paused. So that's just some of the thought process that I go through, that I use that first 15 minutes of no trade for, to kind of get an idea of, are we going to trend off the open? Are we going to be moving sideways? You can kind of see some developing price action, and then you can use those highs and lows as reference points. So in the grand scheme of things, 15 minutes isn't going to make too much of a difference. But in cases where we do gap and we are likely to run, that's where the 5-minute play comes in super handy, because unlike today, where we only traded down for roughly 10 minutes and then we traded all the way back up, on a gap day, the chance of us actually moving outside of the prior day's range and then trending is much higher. You don't see it quite as much on the pullbacks but most of the days on this pullback have all been inside days. But like here, this was the prior day's range, tight range. Well, it was Monday, so markets closed, but essentially a gap down from the prior day. We're outside of that prior day's range, and then we had more trending, more follow through on Tuesday. Typically on 3-day weekends like that, I consider Friday the prior day, but in this case, it did end up working out. So now, as we have this V reversal, I don't, yeah, good job, Patrick. There's a lot of opportunities out there if you're patient, and if you can get through the tough days, the choppy days, without making mistakes and blowing up your account, then you're going to have money and capital to trade on the good days, and those days seem almost effortless. When you hit it right, it's pretty rewarding. So a little bit bigger picture, drawing from highs of the morning down to lows. We can see, well, there was no retracement at the short, or there was no sort of bounce reaction at the short. Now we turn around and draw lows to highs, and we can see, okay, well, maybe there's going to be something here, and if we can trade at the 50 and break through highs, that may give us some legs to start moving up on, and then we can start taking longs. So again, using the information from the first 15-20 minutes to give us some context and kind of put together a picture in our mind of almost like reaching into our memory and pulling out prior scenarios of other days that we have traded. That's how I like to think of the first 15-20 minutes. So yesterday's high is a 95. So that'll be the threshold for us. If we break that, I want to see, do we knock our head on 95s, or do we break out and push through it? Now this pullback here didn't quite make it to the 50, but close, and in a low tick. Not the lowest tick of the day, but I like to see, when I'm getting long, a low tick, or when I'm getting short, a high tick. So I didn't have an order out here because there really wasn't any sign that the high to low traded or the low to high was going to trade. So still just using it as a reference point. As long as we're within the high and low of the current high and low, I would be trading very, very cautiously. And the only trade I would likely take is a long down at lows, or possibly a short at highs. Or if we start, sometimes what happens is we set up in this low to high, we pull back to the 50 and start moving up in a nice series. And as we get close to breaking out, I might take a long in the move up before the breakout as sort of an anticipatory, okay, if I can get in here before the breakout, then I can just trail my stop once we do break out. Yeah, you bet, Mike. When it comes to the opening range, we're about 2 minutes from the top of the hour. So I consider the first 15 minutes is kind of my no trade zone. And then the first 30 minutes, I consider the opening range. For those that kind of follow along with the market profile, the opening range gives us a good idea of sort of what is the range of the day, or what is the range as we start the day. A very tight range in the first 30 minutes is likely not to hold. We're not going to stay in a 2-point range all day long. So if the first 30 minutes is a really big range, that first candle, like yesterday, 8 points, well, there's a good chance that we might not move too much outside of that range. And yesterday, if we look at the first candle in relation to the entire day, it's almost half the day. Today, similar, we're at 6 points, but a little bit smaller range, with the potential now here as we move up to get some trending action. So 6 points, 8 points is kind of on the edge of small. On a day where we have a real small opening range, like back here, only 4 points, well, we broke out of it and moved away. We closed much further away from that opening range. So and again, the prior day, the 29th, opening range was 4 points. So if there's a smaller opening range, there's a good chance that we're going to break out or break down out of that. If it's a big opening range, if the first 30 minutes has a wide range, then there's a better chance that we're just going to stay within that range. And let's see here. So the next long is a 28.91 1/4. I'm just trying to see if the factory orders number is hit yet. That trades. Yeah, Daryl, good eye on the high tick at highs. Anytime we have a high tick that lines up with highs or a low tick that lines up with lows, that could be the high or low of the day. So, going into being a minute before the number, I didn't see the number, the factory orders number out. So even though you get a setup, if it lines up right with a number, you kind of have to play a little bit cautious, or really just go into it expecting that, okay, there could be a huge whipsaw and I could get taken out with a lot of slippage. So that's why I don't like to place orders right before a number. And so now that we have the high ticket highs, if we can come down and break the 61.8, then we may have an opportunity here for a short. And now we are through the factory orders. So the timing on the long didn't really line up with that factory orders number, so which is fine. There's going to be a lot of drawings that you draw up that you filter out. So that same 91 being the short, actually a 90.75 is where I'll place my short order. We didn't quite break the swing low, but the high ticket highs. And then now we've got came down to the full halfway back of the day. So a mixed bag in terms of we've got a long trading and then now a short trading. The high ticket highs should have a little bit of weight. It's not super high, but you know, at some point you gotta pull the trigger and go for it, if you will. The long did trade first, but the high tick happened first. So we'll, you know, you kind of sometimes as you get back into the rhythm, you place a trade and you see where it takes you, and then you can use that information to make good trading decisions to help those continue throughout the day. So anytime you're placing an order at a 50%, you're placing it at a good location. Your reward to risk is typically in favor. So the bigger part of it is letting it play out and not micromanaging the trade. So a little bit of a reaction here at the short. We'll see if there is any follow through. Back at the long. Now, in a situation like this, where we have a long trading and a short trading, we didn't quite break the swing low here yet, but you can consider taking your stop down, and now we broke the swing low, so definitely tightening my stop to a 91.75. So bringing it in, you know, it reduces the risk on the trade a little bit. First target is down here at 88.75. I had it at 89. Whoops. So close is close enough. The first target for me got hit here at 89. Well, I take the target, negative 23, and then I'll round up and add a tick. Sometimes as I'm doing quick math, I can, you know, a tick here and a tick there is not going to make a huge difference. So you get close is close enough. So now the negative 23 fully trades. Now we got a couple of things we can do. Stop is fairly far away from the target. You know, it's still up here at the just above the entry candle. If you've got one contract, you know, as I always say, you develop very good habits by taking it off at the negative 23% target and then moving on to the next trade, drawing up the next short. But once you can get over that hump of one contract and go to two, now you have a whole world of possibilities with just two contracts. As we start moving quicker down here, you can start trailing each candle's high if you want and expect to get stopped out very quickly. You can trail the next 61.8, so you can draw up the next developing short and then put your stop, just round up and add a tick, so 90.25. You can move your stop up there. The trailing each candle's high is helpful. If you have two contracts and you get a decent move like this, 91s, and we're trading it traded down to about an 87, 88. So 3 points there. If you've got three contracts and you take one off at the negative 23, then you can get aggressive with the second, trailing each candle's high if you want. And then the third one, if you get stopped out of that second one, the third contract, you can trail the developing 61.8 or trail swings. Couple things I like to do. This little, when you have one candle that's side by side of another one, and the high, you can use the high of, you know, the bigger candle if you want to give it a little more room See how this green candle came up to the high of 2 candles prior? It broke the high of the previous one. So putting your stop above the high of the candle that made a new low, if that makes sense. You can then trail swing highs, so you can come down and put your stop. If you've got 2 contracts, take it from that original and move it 1 tick above the next swing high, which is now an 88.50. So there's 2 or 3 solid methods for conservative trail stop that's all based off of the chart itself. So we're not just throwing a number out there. We're actually looking, even using the 6018, developing 6018. You're using the market to tell you where to place your stop. As we come down here close to lows, getting low ticks, but not in a new low. Get rid of this long. Yeah, swing highs and swing lows are typically my go-to for the conservative stop approach. And then if the market all of a sudden starts diving off a cliff and I've got a handful of extra contracts left, I'll throw a stop above a prior candle just to lock in a few extra points. And then if it does retrace and move back up here, say to the 88.50s, then you got a few extra points from a couple contracts down lower. You get in a situation here where the negative 23 is way up here. So using the prior swing high to lows, that's almost a full halfway back. So in some cases, if the market breaks a swing high, it could come all the way halfway back as opposed to just making a little move higher. So that's where the swings are beneficial. So now the next swing high, 87.50, move my stop down there. And then as we get lower here, the chances of us getting stopped out becomes greater. But you'll notice once you get away from your entry, you're in pretty clear territory. 708. So no low tick at lows. Starting to see some of these retracements on the 512. Nicely move in a series. But we are down now at lows for the morning. So see on the 30-minute candle, we just went from the top of the range to the bottom of the range. And earlier I said the only thing I would take in that range is a short at highs or maybe a long at lows. And that's why, because when we come up to the top of the first 30-minute range and get resistance, we're likely going all the way to the bottom. It's not always a huge move. In this case, about 6-7 points, but it happens pretty quickly. Feel free, if you have specific questions, you can type them in the chat box. Happy to address anything. So now breaking lows of the morning. Yesterday's low still a ways away, 77.50. So just going to keep trailing here, trailing each swing high, 86.75. When you decide to trail each candle's high is kind of up to you. Early on, you might say, well, I got 3 contracts and I took one off at the negative 23. Now I'm trailing swing highs with the second 2. And now all of a sudden we start diving off down here and you think, okay, we've already moved 8 points from our entry. So I'm going to take this second contract that I've got and start trailing swing highs. Here's another situation where, see how this candle low is the same as the prior one right here. So just if you're trailing each candle's high, I would leave my stop here until we break that candle's low. And the next two candles did not do that, and then the next one did. So here again, leaving the stop, if you're trailing each candle, leaving the stop above this guy, and then now we're going lower again. So then once this candle closes, now okay, now you can take it. See how fast these candles move sometimes? That's why, rather than just getting scared and saying, oh, hit the flatten button, or oh, I'm just going to move my order to close out down here, just trail it, and then you're still have to constantly be moving your stop, but you have open-ended potential to the profit side, and all you're doing is capping your losses. You can use this swing high if you want, this little green candle as your next swing high, even though it's very tiny. But now we're really getting 10 points into this short, and there's not a lot. If once we bounce, here's that low tick at lows. When we bounce, it could bounce us pretty high. So that trailing each candle's high now definitively taking us out of that next contract. And then the last one, for those who have 3, or if you're multiples of 2, if you're trading 6, you could take 2 off at the negative 23, trail swings, take 2 off by trailing swing lows or at a low ticket lows here, and then keep the last 2 for trailing above swing highs, or above swing highs or the developing 61.8. So kind of a lot happening in a very short amount of time here. Try to narrate as best I can. So for that last portion, if you've got a few contracts, stop 83.75 would be a more conservative place. And if we can break down below lows, this next swing high, but that low ticket low is likely to give us some lift here. If we were to come down and make a double bottom, I would put my stop above this swing high. Now we're definitely getting some lift and likely to take out this stop and close out this short. The low ticket lows, sometimes just taking the very next long, like let's say you were not in any trade at all, just taking the long after a low tick that lines up with lows is fine. I would consider that a valid trade. It moves quickly, and even though the distance between the 50 and the negative 23 is small, there's likely going to be a bigger push up to maybe the full halfway back. But because I'm still in the short, I can't take the long without being out of the short. So, and sometimes that's enough to just dictate which trades you take, because you're in a short and you're trailing your stop on that short, so you can't take the long. In some cases, I'll close out of the whole trade at a higher low tick, but I do my very best to at least hang on to 1, maybe 2 contracts as long as I can, because those extra 4 or 5 points or that extra leg lower, even if it's just 1 contract, 4 points with 1 contract, that's a good move. I don't care if you're trading starting with 5 or 10 lots. A couple of points per contract it adds up. So, fast mover, a lot happening, but very, very structured in the way it's adhering to all the things that we talk about here. Getting in a trade, managing a trade, starting with a 6 tick stop, trailing your stop, taking a portion of the trade off at a very small first target, not very small, but 1.5 to 2 times your risk. Locking in, the idea is to lock in a little bit of profit and then reduce your risk to essentially where the trade can't go against you. And you're in a free trade, then for those that are trading live, your pulse can slow a bit and you can be a little less nervous. You've locked in some profit, and then you can calmly manage the trade from there. So full 50% retracement is an 86. See if we make it up there. And that would be the bottom, just about close to the bottom of the first 30-minute range, which is great because the market likes to come back up. Now that we broke the first 30-minute range, coming back up to it should act as resistance. So you can see the pace of this trade is slowed dramatically. But I'm just going to leave my stop here at 83.75s, and if it gets hit, great. If it doesn't, maybe eke out another couple of points. This is why it's really important to familiarize yourself with the trading platform you're using on a sim account first, so you can get real comfortable with where all the buttons are and what things that you want. Clean up your DOM just like I clean up my screen. I kind of get rid of everything that I don't need on my Infinity platform. Having that flatten button, cancel all, very important. And just simple trading ladder. I don't use any of the level 2 advanced data feeds, stuff like that. So there's another leg lower. So not much room to move the stop, but 83.50. And look at how fast we bounced up. No new low tick, but the bull's definitely interested in buying down here at these lows, which happen to line up with that gap that we talked about back here, and sort of down at that support level from the breakout. So just methodically going through and trailing on the way down. And there's our break. Trade over 83.50. And if it rolls over and makes another leg lower and, just takes you out here, you can't let that bother you. This leg here, this portion, the trade has been much slower than the earlier portion developing from the 91 down to the 90 or to the 80. The 10 points fast move, and then this choppy, slower move. So pretty solid trade. Even, going back one contract would have put you to the negative 23% target very quickly. Let me clean this up a little bit. So on the short side, moved right down to the negative 23 with 2 contracts. If you were to start trailing your stop above swing highs, definitely a solid move on that second contract. If you maybe got a little bit nervous and started trailing each candle's high, still some good couple extra points by trailing there. And if you've got 3 or more trailing on the way down, keeps a lot of profit, or adds a lot of profit to the mix. All right, so let's see where we're at here. We've got first 30-minute range that I'll leave up. Let me get rid of this 91 short since that trade's over. Now down here, I would expect us to get a little bit of lift, but chop around before we do. The market just made this big move. A handful of traders were able to catch it and be with it. Now they're kind of digesting some of their profits, closing out of a trade. So we don't want to get overly excited and just jump back in before we had an opportunity to really assess what's next. We do have this, so we don't have a low tick that lines up with lows, but from low to this high broke the swing high back here. So I'm going to draw up this long. I'm not in this trade, but just drawing up to get a reference point here. The long did get a little bit of a reaction. It's not so much about the number of trades that you take, it's about maximizing the duration that you're in a trade. after a trade, it's nice to kind of get up and stretch or refill your coffee, or just kind of leave the screen for a minute and then come back. I find that can be helpful. Whether good or bad, it's a helpful way to almost force some patience. Let's take a look at our stocks here. Talked about this Apple breakout a week or two ago. Looking good. Now getting a new high tick, not very high, but sort of up at the close to the bottom of the first 30-minute range. But kind of messy down here, trading through the 61.8 before making it there. So one move, one leg up to the target, about a 3/4 of a point away from the first 30-minute low, and then now coming down, making new lows. When we get in situations like this where we don't make it all the way to the first 50% retracement, this time of day, the next 50% retracement, I would want to line up sort of with these lows over here. So we have a little bit more confluence. So the short here, it's not super appealing because we're bouncing off of these lows. Not to say that we can't go lower, but in 81 is where the short would be. With ticks going from high down to low, this pattern kind of mimics what we're seeing here. That usually a sign of a little bit more volatility. Speaking of which, as the S&P breaks out, what is the VIX doing? Not really breaking down or moving lower, so kind of bottomed out around 12 with this little dip to 10. Double bottom coming into this short. I don't really like that. Double bottom at lows definitely shows that there's some bulls interested. And so if we look at where's the full retracement, 28, 85, 50. Oh, what do you know? Right at the bottom of the first 30-minute range. So this time of day, I would expect maybe a little more of a reversal up to that. So maybe some back and forth here from lows in between this 81 short and lows. We'll see. Didn't even have a chance to look at the NASDAQ today yet. Didn't make the double top that we saw on the ES. And that's breaking lows. Interesting. So the 81 moves a couple points from its short. You can see how, even if you pick a 50% that may be low probability, there's still usually going to be a reaction and at least take you down. If it doesn't make it all the way to the negative 23% target, it holds its 50%. It adheres to its 50%. I do have a handful of more emails to get through. So if I haven't responded to your email from over the weekend or earlier this week, should be hearing from me later this afternoon. You can see how a lot of the faster, bigger trades occur kind of in that first hour. A little bit more movement, a little more trade activity. The market still wants to go lower. And there's a break of yesterday's lows. So that 28.75.25 is just below us, the prior all-time high. Low ticket lows. So there is a low ticket lows here. Now we have a low after that low tick, so could continue to make new lows. Also kind of at the bottom of this channel as well. Downward channel. Something like that. So I wouldn't be surprised to see some kind of a bounce here. That next retracement that we talked about at the open, from lows to highs, I'll draw that up though, is a 60.25. So if these prior highs can't act as support, then me just coming down another 10 points or so to 60, 28.60, give us some support. Double bottom breaking the little swing high. Don't quite have a low tick at lows, but could be a temporary bounce. 73.50 the current long. So from highs to these lows, traded down to the negative 61.8. The next short, still well below the first 30-minute range. But not looking like it's going to pull back into a long just yet. So yeah, I'll wait and see if there's a reaction at the short. Not going to put a blind limit, expecting some sort of a bounce here. Coming up to, so yesterday's low could act as resistance, 77.50. So that is right near this next 50% retracement short. So maybe be able to get a little short play off of that level. But nonetheless, pretty good morning. So I'll draw up both the long and the short, see which ones trade, and pretty big movement in this first hour and a half. If we sell off more than that, we'd be diving below the bottom of this channel, this lower end. So maybe some kind of move up to 28.85s midday and then roll over from there. But nonetheless, pretty good morning. Good way to start things off. And like I said, if you have questions I haven't got to via email, I should be finishing those up later this afternoon. So I'll also get this recording posted. I know there was a lot happening in the short, and you'll be able to review that under the trading sessions in the member dashboard. So any other questions, feel free to shoot me an email, tim@eminimind.com. I hope you have a great day, and we will talk to everyone soon.